Hello and welcome to this 2023 Lunar Investment Outlook. My name is Alex Brandreth, Chief Investment Officer at Lunar Investment Management. 2022 was certainly a very volatile year. We saw the invasion of Russia in the Ukraine. We had a very strict Chinese COVID policy, and that led to soaring inflation, which has led to the cost of living crisis that we seem to be reported on every single day from the press nowadays. But that's what's happened. In this video, we want to look about what's expected to happen from this year and what the impact of these different drivers from last year are going to have. So I'll now go through our 2023 outlook. The big story from last year was inflation. This chart goes all the way back to 2011, and you can see inflation was in a range of 0 to 5% for a very long period of time. We were expecting inflation to pick up in 2022. That was because it was the first full year that the economy was emerging out of COVID restrictions, and demand was increasing, and it was expected to be a strong year for economic growth. And in that environment, typically inflation does pick up, and you've seen this happen after several recessions in the past, that inflation tends to accelerate. And if we look back here to the 2011, which is when we're coming out of the financial crisis and the European debt crisis, you can see inflation was around 5%. And that's sort of where we're expecting inflation to be last year. The game changer, though, for inflation last year was obviously Russia's invasion in the Ukraine, and that turbocharged inflation to a peak in November of 11.1. You can see there that the very last month of the year, inflation did fall down. It started to fall. So inflation is a key topic, but it does look like it's peaking. And this chart looks at economic expectations from economists. It's the purpose of showing this chart as well is it's not just a UK inflationary issue. This is a global issue. We're all being impacted by the same increase in commodity prices. And on this chart, you've got the UK in that light blue, Europe in the purple, and then the US in grey. What's interesting of note on this is the fact that the US has already seen peak inflation. In fact, the US inflation rate has now fallen by 5 months on the row already, and it's in early 2023, it's expected that it will fall for a 6th consecutive month. I mentioned the UK has already started to fall, and you can see that as we go through this year, the expectation is that inflation starts to come down. Now, there's a number of reasons for this. The first is the way that inflation is calculated. It's an annual calculation which looks at the prices a year ago to where they are today. And as we get to March, when we'll be doing that at when the peak of the Russia-Ukraine war impact on commodity prices. So to highlight that, the oil price got to $140 back in March 2022. And at the moment, the oil price is down at $80. So that's why you've seen petrol prices fall quite significantly already, because the oil price is significantly lower. And that's just one commodity, but that gives you an idea that inflation is expected to fall this year because of that annual impact. The other important aspect is that the cure for high prices is high prices. And what I mean by that is that if goods are too expensive, then individuals will vote with their feet and just stop buying. And that means that prices have to come down. So that is a natural rebalancing that will come through as well this year. And finally, I mean, we head into 2023 with the UK probably already in recession. Recession is classed as 2 negative quarters of economic growth, and it's likely that Q3 and Q4 were negative. And a recession or weaker demand is also deflationary as well, so you should expect that to have a negative impact on inflation. On the flip side, we're still seeing record food prices within the UK. You're still seeing wage inflation running around 5% within the UK. So there's definitely some inflationary impacts that's still going to be felt, which are going to come through. But the expectation is that inflation gets to around 4% by the end of the year in the UK. And the US, which is energy independent, which is one of the reasons why their inflation didn't get to the levels that it did in the UK and Europe, it falls significantly. And why does that matter? I mean, it matters because in 2022, central bankers were fighting inflation by putting interest rates up. And they were doing that to try and to keep inflation, bring inflation down. And inflation is going to start to come down, and it releases the pressure on central banks to be able to do that. Now, on this chart here, on the left-hand side, we show economic growth expectations for last year, what was delivered, and the outlook for 2023. And we've got a number of different countries on here. You've got the UK, Europe, US, Japan, and China. You can see the UK, and that grey bar there was one of the fastest growing nations in 2022. That was mainly in the first half of the year. But it's expected that this year is going to be a tough year with economic growth contracting. That's a very mild recession of -1%. So, I mean, we need to put it in context. We've seen some very severe recessions with the financial crisis and COVID. It's not expected that the recession that we're going through at the moment is going to be anywhere near as bad as that. Europe is going through very similar to the UK because of the reliance on natural gas and the increase in energy costs. The US tends to grow at around 3%. So that means that last year and this year are both going to be below trend growth for the US economy. Japan's the anomaly there, where it just kind of keeps chugging on at 1% growth or so. But what I really wanted to highlight on this chart as well is the complete reversal in the fortunes of China. Now, China really weighed on global growth in 2022 because of its COVID strategy. We've seen this so many times that when you introduce restrictions, then it has a negative impact on economic growth. But when those restrictions are eased, it's almost like a coiled spring. Economic growth bounces back very strongly. And that's exactly what is expected to happen within China this year. It's not just their COVID strategy which changed at the end of last year. They also made a number of important changes to the property market, which is really important to the Chinese economy. And China really matters now. China matters because it's such a big nation and it has a big impact on global growth. So this is a positive. It's a positive that China reversed their COVID strategy. It's a positive that they sorted out the property market, and it can be a real positive to markets and economies in 2023. On the right-hand side of this chart, it's looking at Purchasing Managers Index. What are they? So it looks at both the service and manufacturing side of the economy. And it sends out a survey to business leaders and says, well, are conditions getting better? Are they getting worse? Are they still the same? There's a dotted line on 50 because if the line is above 50, it shows you're expanding. If you're below 50, you're contracting. You can see, again, we've got the same countries on here. We've got the US in grey, Eurozone in purple, and the UK in that kind of light sky blue colour. And this goes back to 2010, and you can see that on average, you've got a little blip here around the European debt crisis. On average, we've had expansion. COVID, there was a big contraction. We rebounded from COVID and had another expansion. But this is now saying that economic growth is likely to decelerate from here. This is quite a good on-the-ground indication of what's happening. When the quarterly economic data is announced, it's normally a few weeks after the end of the quarter. So it's not very timely in terms of understanding what's going on with the economy right now. Whereas this is give you a very good indication of what's going on with the economy right now, excuse me, in real terms. As I mentioned, central bankers have got an incredibly difficult job at the moment. On the one side, you've got soaring inflation, which is starting to come down, but is still very high. And on the other side, you've got weakening economic growth. Central bankers have got a dual policy to keep prices stable, but also to maintain the economy. And at the moment, they're fighting the inflation battle and not the economic growth battle. Now, interest rates in the UK increased significantly last year. We started 2022 with interest rates at 0.25% and ended the year with interest rates at 3.5%. Looking forward, it's expected that interest rates do pick up in the first quarter or so, maybe a peak of interest rates being between 4 and 4.5%. We don't think that they can get much higher than that because of how heavily indebted the UK economy is. and it just increases the amount of debt service costs if interest rates go too high, which will really impact the economy as well. So, but that's expected by the market. The market is expecting interest rates to increase. The key question is, well, how quickly does inflation fall, and how weak is the economy, and how deep is the recession? They're the two important questions, because if the recession is deeper and inflation falls back quicker, then it's possible that you could see interest rates starting to be cut towards the end of the year. And that would help stimulate the economy, and it also presents a change in central bankers' direction. Last year was all about increasing interest rates because of inflation. The end of this year, it could be cutting interest rates to protect the economy. This is my favorite chart at the moment. It shows you how sad I am. I've got a favorite chart, but on this, it just goes through the boom and bust cycle, contrary to what Gordon Brown told you in the past. And you can see here that we go through periods of expansion. It's this blue line, what's going on with the economy. We have a peak. The 2007 was a clear peak, and then you had the financial crisis and you had a recession. You then have a trough. You come out of recession and you recover and you expand, and this happens over and over. Cycles can be different lengths. They can be shorter, they can be longer, but we have economic cycles all the time. The important point on this chart, though, is this red line. That's what the stock market does, and you can see it shifted slightly to the left of what's going on with the economy. Maybe the peak is the best way of seeing it. And that's because the stock market moves in anticipation of what's going on with the economy. And we're seeing this time and time again, and that lag is about 6 to 9 months. So the stock market's moving 6 to 9 months ahead of what's going on with the economy. That's important because I said we're in recession, yet stock markets can actually perform well in that environment, because it's the expectation that they're going to recover in the future. And we've seen this in the past. So just to provide two examples of that, in 2009, the stock market bottomed in March, but the economy didn't come out of recession until the end of the year. In COVID, the stock market bottomed on the 23rd of March. That was the same day that Boris Johnson stood up and said that the UK was going into a national lockdown. It can often feel very dark, but that doesn't necessarily mean that it's the worst time to be invested. Often it can be the best time to be invested is when things are as weak as can be. And, you know, at certain points last year, at the end of June, the end of September, it certainly felt that was the case. You had China's COVID strategy, you had interest rates increasing at one of the quickest rates on record. You had inflation in double digits, which was expected to accelerate. You had a war in Europe. So there was definitely reasons to be concerned in 2022, and that's why asset prices across the board fell. But as we're going into this year, China have now reversed their COVID strategy. Inflation looks to have peaked and is coming down, and valuations are a lot more attractive. So maybe it's not a year to be overly concerned about what's happened in the past. And that has left valuations at very attractive levels. On the left-hand side here, it shows what the expectation is from markets in terms of global earnings per share. Excuse me. And you can see the different regions here, the world, the US, Europe, UK, emerging markets, and China. 2023 is the grey bar, so what's the expectation for this year? 2024, what's the expectation for next year? And I suppose the first positive thing to say is that they're all positive, so maybe everyone's over-optimistic, but there's no expectation that, despite the fact that the UK economy is in recession, that's going to impact UK earnings. And that's because UK earnings come globally. They come from the US, they come from China, more so than they do from the UK economy. But it's expected that earnings are going to be relatively robust globally. On the right-hand side of this chart, it shows the P ratio, which is the price to earnings ratio. To provide a quick explanation of what that means, if you're up at 40, it means it's quite expensive. If you're down by 5 to 10, it means valuations are very cheap. And this chart looks at different regions and where we have been in the past. So the grey bar represents the range between from now to 1990. So its cheapest point in the US market was at 10 times, and its most expensive, it was just over 25 times. The green bar represents, well, what has been the average from 1990? And this blue triangle, a diamond, sorry, shows, well, where are we today? And you can look at the different markets, and I suppose there's a couple of things that I want to really highlight, and it also gives you an idea of how Luna portfolios are positioned going into this year. The UK there is very close to the bottom of its range since 1990. It's the cheapest market overall from a P ratio perspective. China's very close, but it pips it just being slightly cheaper. And this is after the FTSE 100 was one of the best performing global markets in 2022. So it just highlights that valuations within the UK are still very attractive, and they have been for a number of years because of Brexit, ultimately, and potentially because of the political change in 2022 had a big impact on UK markets as well. The other extreme is the US. The US equity market fell by about 20% last year, so quite significant fall. But you can see that it's still slightly more expensive than its average valuation. And that's because a lot of the US market is made up of technology, which has fallen, but it's still pretty cheap, pretty expensive. Whereas the UK is mainly oil, miners, and financials, which, although have had a good run, are still very cheap compared to the long-term history. China's the other one. The Chinese market bounced very strongly at the end of last year and looks very cheap. And that has a broader impact on emerging markets, with China being the biggest emerging markets. So as we go into 2023, we're doing so with valuations at very attractive levels. That's going to stop sharing there. Just wanted to thank you for listening to this today. Just to reiterate the key points, inflation has peaked and is likely to fall. It's a very challenging backdrop from an economic perspective. The UK is probably in recession already. Economic growth is expected to contract this year. That being said, that doesn't necessarily mean that it can be a bad year for equity markets, because equity markets look forward by 6 to 9 months. So if you're thinking about investing in equities today, you should be thinking about, well, what's going to be happening in July to October this year, not necessarily what's happening today. And that is an environment where inflation's going to be falling, be significantly lower than it is today, and economic growth could be picking up then. The UK could be emerging out of recession then. So that's why markets have started 2023 quite positively and ended the final quarter quite positively as well. Valuations, despite the UK being one of the best performing stock markets in 2022, are still attractive. Interest rates will not provide the shock that they did in 2022. They will creep higher, but a lot of the heavy lifting has been done by central banks in terms of addressing interest rates. That's all for me. Here's to a better 2023. Thank you for your time, and again for listening to this today. All the best.